Hi, in this video, let's talk about a time when I did a lot of investment research and I found out a value pick and it had everything going well for it. Numbers as well as the story. But still, I lost close to 80% of my investment. So it all began with my newfound knowledge of fundamental investing or value investing. And I used to read a lot of annual reports and I used to go through a lot of valuation metrics. So I found this stock which was like a very promising stock. Now I'll explain you why. India contributed around 90% of this commodity in the global market, and the company which I found was like the major provider of this commodity, and you can say this was like a monopoly business of this company of this commodity. Now after going through the annual reports, looking at the various kinds of multiples, there were few very stark numbers which were like drawing you into that stock. And if you remember my previous video about numbers versus a good story, you will understand that there are various ways to pull an investor into a stock. Let me just show you a couple of charts which will draw any investor. So you can see over here, revenue, EBITDA and income has been plotted for 4 periods. Now you can see over here the analysis is done till 2012, and then as this investment was being made on year 2012, so you can see the last 12 months the LTM is also for that duration when I was making that investment decision. Now this is a very promising chart because you see the revenue is rising, the EBITDA is rising, the income is as well rising and at a very fast pace. Now let's look at the cash and debt situation of the company. You can see even the cash is rising by a lot and the debt is stabilizing. So if you just look at the revenue growth and the cash debt situation, you will be compelled to say that this is a pretty good investment, and you will be not wrong when saying so. And that is what I did. I formed a conclusion that this is a pretty good stock to invest in, and I invested a lot of money in that stock. I earned a lot of dividend income also from that stock. So you understand that dividend income may be a cause of your downfall as well. So be wary of companies which have very high dividend and they don't offer much growth sometimes. And as per my estimation, I expected the stock to rise by 2 to 3 times at least. And surprisingly, after I put a lot of money into that stock, it started falling down. And when it started falling down, there was like no end to it. And I remember that from around, let's say, 60 or 70 rupees, it fell down to 20 rupees. And around that point of time, I started panicking a lot. And that point of time, I started understanding that I have put my money into a non-performing stock, and I started to exit from that company. The lesson which I learned was that though it had compelling numbers, it had good story, but there are a lot of reasons why a company's stock might not rise, would always remain down. Now, obviously, value investing has a lot of layers, and there is something called company knowledge. And company knowledge is something which generally is not very easy to find, and there are a lot of developments which you are not able to track. So value investing is not only about reading the annual reports and preparing various kinds of valuation multiples. You also have to get some kind of a company knowledge as to, are the numbers really making sense? Is there something more hidden in the annual reports and the numbers? So you have to dig a lot deeper. And if I just tell you that, let's say you don't want to do a lot of research and you want to cut down on your risk. So this is not an investment advice, but still what you can do is try to think about the amount of corpus you want to invest in a good company. Let's say you have found that company such and such is a very promising bet. So how do you invest your corpus? Let's say you want to invest 100 rupees into it. Don't invest the entire 100 rupees into it. Keep it in a staggered way. First put 20, then put 30, then more 20, then more 10, and then see how the stock is performing. And if it's rising and has a good momentum, put more money, and also have your exit points clearly laid out, and start booking profits from very early stage, so that even if the stock starts falling down, you know how and when to exit, so that you don't lose money, you rather gain money from all your investments. Now this is something which has like very less risk, but it still is not risk free, because you're not investing in a fixed deposit, you are investing in a risk prone equity market. So that is why you must be willing to lose the entire amount of money which you are putting in stock market. That is given. But I hope I told you that there are situations where the numbers could be great, the story could be compelling, and still the stock will not earn you good returns. And that is exactly what happened to me around 9 years back. And essentially, if a company is like in a monopoly business, the revenue EBITDA is growing, and you also have very high cash and low debt or stabilizing debt, you will be compelled to invest in that stock. But whenever you find such a stock, don't put all your corpus into that stock. Put a staggered approach and always have well thought of exit points. I hope you found this video useful. If yes, give it a thumbs up. And if you want to watch more videos on finance, economics, investing, data science, R, Python, maths, and any kind of knowledge, don't forget to subscribe.